Hello, I'm Peter Towers, Managing Director of ESS BizTools. Welcome to this webinar today, where we're going to look at real-time results, turning reports into action. So thank you for being with us today. Real-time results, turning results into action. The first thing that's required is establishing systems for the business. And accountants and bookkeepers who are looking to supply these services need to be thinking through how all this is going to work with your clients. The first part of the overall preparation is a business analysis. This is a very important component because if you've been used to servicing your clients with the preparation of an annual set of accounts and an income tax return, let me ask you a question. How much do you really know about how your client's business operates? Do you know where all the locations are? Do you know who's in charge of security? Do you know what the costs associated with the building or the assets are? Do you know who's authorised to purchase products on behalf of the client? I doubt it, because in my experience, when I was the senior partner of an accounting firm, I found that I didn't know the full operational side of things either. So we need to know how the business operates. 1 inch wide, but a mile deep. And it's that mile deep that's very important, because that will give you the overall feeling of how things are operating and who's organized to do what. And it will give you a great insight into the internal control system operating within the business. And that's very important, because once you start going beyond taxation into supplying this wider range of services for your clients, I think you've got a real obligation to make sure that things like internal control are working appropriately, and if not, to bring them to the attention of the leadership team. The next aspect is to identify systems. Systems are vital for businesses, and they should cover every aspect of the business operations. So it starts with the physical assets of the business, the location, the title deeds, the security, the condition of those assets, and probably many other things. Then we need to look at administration. How's this business administrated? Is there a board of advice or a board of directors? What reports are submitted to them? Who's on those boards? What's the agreed distribution of information for their meetings? I recommend 72 hours prior to a meeting, everything should be distributed, because you want that board of advice member or director to be informed, to turn up with an understanding of the entity's current position. Now, if there's a last minute update, sure, that can be tabled at the meeting. But the main thing is to help those board of advice members or board of directors to turn up with their brain engaged. They understand the latest figures. Financial, what's the financial system? We're going to talk more about financial as we go through it. The rhythm of meetings, daily, weekly, monthly. Are they set into the timetables? The people understand them. The main meetings that I'm referring to here are for the leadership team, but each other team should have its own rhythm of meetings. And the leadership team members need to be aware of that and attend the ones which apply to them. Purchasing, who's got control on purchasing? Human resources, who engages team members? Who sets their salaries and other benefits? Looks at their training, make sure they've got the required certifications to attend the various functions within the business. They might be heavy vehicle drivers. Have they got the licenses? Are they electricians? Have they got the right permits to be undertaking various aspects of their role? team training and professional development. It's very important for a business that's growing to make sure that team members are properly prepared. Technology, what's the technology status within the business? Is everyone across the current technology, or is there upgrading needed? It might be an AI or other things. Product development, what products does this business produce? What's the program for continual review of products and developing new products and services? Patents and confidentiality agreements. Who maintains the records? Who's monitoring the life of the patents, which only lasts for 20 years? How many years is there to go? And what's the alternatives to be developed for when the patent expires, when the business has no longer got that protection? Research and development processing. What's the systems for undertaking a research and development project? Is it known to the team members? Can they identify something and think, geez, why don't we change that? Do they then know what the process is? And does the team understand the records that have to be kept relating to research and development? Software and artificial intelligence that's being used within the business. Is it documented within the system? Communications. How does this business communicate? Say, present webinars and Zoom meetings. What other forms of communication are being used? How are the minutes of the meeting prepared? Is the AI resources on Zoom being used to prepare the minutes? And is someone checking them? Because unfortunately, they're not 100% correct. It's even difficult when you've got a human there taking the minutes of meetings at times, isn't it? What about competitors? What's the documentation that's kept on competitors? What's your system for your clients to monitor their competitors? It's a very important part of the process. Not being caught unawares. Customers. System for customers. How often does your client want to communicate with customers? Is there a customer advisory committee meeting so that there's feedback being received on issues confronting customers? What's the marketing strategies? These should all be documented within the system for marketing so that if someone's absent or on holidays or leaves, all the information doesn't walk out the door, because we need to remember there's a lot of intellectual property for the business in the head of the various team members. That is an asset of the business. It needs to be documented. And that's why the concentration's on systems. And sales. What's the process for making sales in this business? Is that documented within the sales system? All businesses require good systems to be documented and regularly reviewed. Have changes been made? Were they authorised? Are they an improvement? If so, they should be documented within the system. If systems are not developed in this way, most experts believe that a SME will have problems expanding beyond 10 team members because the business will not have the resources. One person cannot control a large number of people without having effective systems and then appointing various leadership team members to ensure that those systems are implemented. But we don't want each individual leadership team member just going out and changing things, because that creates a lot of uncertainty and disharmony within the business. The next aspect of building up to understanding the business is the strategic planning that's needed. And this starts with a business plan. I think the business plan's a very important document. It follows the business analysis, where you need to know more about the business and document that so that your team can review that before they have any contact with the clients. But then there's the business plan. I don't support the theory that an accountant or any sort of advisor would just go off and write the business plan and submit it to the client. We need the leadership team's involvement. And in fact, I'm quite happy for the whole team to be involved, but that will depend on the CEO and the leadership team. whether they're happy to have the whole team involved. But we're dealing with SMEs. They don't have thousands of people working for them. They'd be lucky to have 100 people working for them. So it's quite possible to bring them all together. Now, they could be located in different locations around the state or even around the country. But with today's technology for communication, Zoom for argument's sake, we could have a Zoom meeting with the whole team present and have their input on certain matters. It mightn't be for the full process, but at least they have been consulted and asked. And at times, they're the people who have got the best view because after all, they're at the coalface, aren't they? So the business plan development's very important, and then it should be getting taken back to the leadership team for approval and preferably their signatures on the document, because they are the group of people who have to implement the business plan. Now, if you're offering a virtual CFO service or a virtual accounting service, you're probably consider them quite rightly as being a member of that leadership team, but there are other people. It's not your role to actually implement it, but you're part of it. And once the business plan's completed, we can then move into the predictive accounting reports. Budgets for all operations, not just one overall budget for the business, because accountability is lost if you do that. If the business has got 6 operating activities, let's prepare a separate budget for each of them. If they've got 20 operating activities, let's prepare 20 budgets so that there is this very important degree of accountability, because there will be a manager or a leader or leading hand or something for each of those activities, or there should be. And that person will then be able to review their budget, understand their key performance indicators that relate to that activity. And they're going to be the person that drives that business activity to be successful. And the next part of the predictive accounting reports is the key drivers of major sub-accounts. And what we're referring to there is items that sometimes get hidden in the budgetary cash flow forecast process. Things like inventory, raw material inventory, as a separate sub-account, so that you can monitor what the investment in inventory is going to be, so that you've got a ready reference when you're analysing the actual performance later on, that you know what the target was, because things can change, especially in inventory, especially if your client's relying on imports coming in from overseas, where unfortunately there are wars being fought at present, which have changed shipping schedules, difficult at times for access through various parts of the Middle East. So ships have been diverted a lot further around, takes an extra 2 or 3 weeks on journeys to Europe. What's that doing to the supply chain to your client? Has your client decided that instead of holding 3 or 4 weeks raw materials, they need to increase it to 8 weeks or even higher? Well, what's that going to do to the business's finances? Because presumably the suppliers overseas still want to be paid as immediately they deliver to the ships. So your cash flow forecast is going to be subjected to extra pressure. The debtors is another key sub-account area. What's the debtors' days outstanding going to be? Creditors is also part of the key drivers, because if the forecasts have been done on the basis that the business will be able to avail itself of creditors' days outstanding of 40 days, which is very generous, but a very efficient payment clerk decides that all the bills should be paid on time within what might have been the stipulated trading terms of 30 days and starts paying on that basis, that can cause havoc in the cash flow. So it needs to be monitored. And if the budgets have been set on 40 days, people need to be told. But we might find that that's not reasonable, because the suppliers may object to that and say, if you don't pay us on a 30-day basis, we're not going to supply you. What's that do to your client's business? Other major areas within the sub-accounts are research and development, which can build up to a significant investment, capital expenditure, and other key items that might get nominated from time to time to be part of the sub-accounts. And this all then flows into the cash flow projection. And the cash flow projection needs to be closely monitored. Some of the items I've just referred to. And all this is then reflected in the projected balance sheet, which is a very important document, especially when we're starting to look at what the return on investment is. So what is the valuation of the business? That will be determined by the projected balance sheet. So all these items are interrelated. And then we move into the 52-week business enhancement system. Now, this might be a new concept for many accountants and bookkeepers you've probably been used to basically preparing an annual set of accounts and an income tax return for your clients, or just maintaining the original books of entry from a bookkeeping point of view. But businesses need more than that. And with today's computers and software, I think we should be embracing the 52-week business enhancement system, which is built around, first of all, daily issues, a daily update on key issues from the previous day. Yesterday's sales, yesterday's average sale, yesterday's gross profit percentage, amount of money in the bank, debtors balances that are overdue, the total, payments to be made this week. It's an alert type document going around to the leadership team. And hopefully it's conveying the message to them that our cash resources that we've got at present are only, say, $50,000, but we've got creditors due for payment of $110,000. The wake-up call to the leadership team members would be, well, 10 days ago, you agreed to go and follow up 3 of your debtors who owe us $60,000 in total, and so on. Go out and get that money because we've got to pay those creditors' bills this week. That's the real purpose of the daily report, but also to highlight something that may have gone wrong yesterday because it needs to be fixed today. And that's the way the big end of town operate. They don't let problems continue for months, or even for the full year before it's found in an annual set of accounts. They want to have things immediately fixed. And that's the weekly analysis, which I think is the most important function that you will be preparing. The weekly performance and profitability report for each of those separate business operations. You've got separate budgets for them. And all this is prepared on the accruals basis, not cash accounting, because cash accounting misses out a lot of things. Just because the bill hasn't been paid doesn't mean it doesn't exist. We need to make sure that everything is brought to account. Now, the weekly performance and profitability report will be based on a few things. Some are known figures, sales are known. Hopefully the purchases are known, but there will be some aspects that the invoices haven't been received yet. But there will be budget estimates for that item that you can extract. Or there will have been an authority for a special advertising campaign to occur this week, and that was going to cost $10,000. That is a known cost, so it should be incorporated so that the weekly performance and profitability reports can be a key indicator to the leadership team as to how an individual operation performed. And if there's a problem, it should be immediately investigated. But to do that, the leadership team will need confidence in your ability and the client's clerical team ability to produce accurate weekly performance reports. It's done in the big end of town. I was the CFO and company secretary of a listed public company. We were a major Australian meat company. We operated export meatworks, retail butcher shops, small goods factories, and other business operations. But every week, by Tuesday, the local area manager had a report on each of the activities that he or she was responsible for. And by Wednesday lunchtime, all of that information had turned up in head office where my team had analysed it, and I would sit down and have a sandwich with the CEO as we worked our way through the results. And what he wanted was the ones that did not meet target. The gross profit percentage was expected to be 38%. They'd only achieved 22%. He wanted then to ring the area manager for that business and ask him if he had found out what went wrong yet, because that person should have known for at least the previous 12 hours, maybe a bit longer, as to what had gone wrong. Gross profit only come in at 38%, should have been, had come in at 22%, should have been 38%. What caused that problem? Because the emphasis was, let's find the problem and fix it, so it doesn't continue to occur. Compare that to your SME client that hasn't got this system, hasn't heard of weekly performance and profitability reports, and you haven't talked to them about it previously. They don't know there was a problem. They might know their sales for that yesterday or last week, but they probably have not analysed it right through. And then we got the monthly financial accounts. Profit and loss account for each business operation prepared on the accruals basis, not cash basis. Make sure you're including the provision for labour on costs. This is part of the accrual system. They're quite expensive, especially when you include superannuation, holiday pay, and other benefits. And then we need the balance sheet, and the balance sheet should be including the debtors figure that's going to be able to be collected. And a review should be made of inventory to ensure that the value is not overstated for any inventory items. The amounts owing to the taxation office should be included. So in other words, all known liabilities, you need to make a check to ensure that they're included in the balance sheet. And if there's litigation underway, I think you need to start providing a provision for a potential payout that might occur. And any other contingent liabilities should be included, so that the balance sheet is being prepared on a realistic basis. Because when we look at the valuation of the business, it starts with the balance sheet. So it becomes a very important document. Then we got the monthly financial reports, which also includes the comparison of the individual budgets against the businesses, their actual performance against the budget, and the preparation of the budget variation report. And then a very important document that needs to be prepared, and that's the summary of the consolidation of the weekly performance and profitability reports. What results was disclosed for each unit on the 4 or 5 weeks in the month. What have we already told the leadership team? And what's the monthly financial account saying? Because we need to make sure that we get those figures as accurate as possible. And I always found it was a question I had to answer once a month as we basically walked into the public company boardroom with my CEO, and he'd say to me, did the weeklies reconcile with the monthly accounts? And when I said yes, he said, okay, because he was running the business on the weekly performance reports and profitability reports. And the board of directors knew that. And that's how a lot of the big end of town operates when they're running individual businesses. And this can help your clients run their businesses more effectively. And this gives confidence to the leadership team, because if you're going to them and saying, well, we thought we would make 38% and we've only made 22%, these are the indicators that we have extracted from the financial data. It now needs the manager and you to, as the area manager, to dig into that result and to find out what caused that to go wrong. They need to have some confidence that your information's correct, that you haven't made a mistake. And part of this is the confidence they will get by knowing each month that the weekly performance reports have been reconciled with the monthly financial accounts. And we used to say we tried to be 98% accurate. Sometimes we were 101%. But it was very important to give them that confidence. You don't want to be 10, 20, 30% out, because they will lose confidence in that information. So let's now look at the result analysis that flows out of all this. We've got all this information going on. And this is what happens in larger business. And this is what would happen if your client was a little bit bigger and they had a full-time accountant working for them. But I'm talking to you on this presentation on the basis that your client's not larger. They haven't got an internal accountant working for them. And it's your firm that's going to supply this service to them. So we need to analyze the results. Well, let's look at key performance indicators. Some of the indications could be the average sale, the gross profit percentage, the number of team members, sales per team member, team training, total hours, hours per team member, professional development, total hours, other business metrics. And within your system, you could have a significantly more. What's the return on investment calculation each month? And this will be based on the valuation of the business. Now, the valuation of the business might only be determined once a year, although I think it could be determined more often than that if you've got the total systems working, because it will be fairly easy to calculate. But at this stage, I'm assuming there's been an annual valuation of the business, and that's what that would then be utilized to calculate the return on investment. So the summary of results could then be documented within the summary of key performance indicators and business metrics. You can prepare a benchmark comparison by using industry data that you would obtain if you were a subscriber to the benchmarking services, or you may have developed your own indicators, and we have disclosed them within ESS BizTools, what some of the indicators you might use for different industries. And from all this, you're going to have actionable advice to your client to be able to sit down with them and give them this detailed analysis of figures so that they've seen an overall profitability that's included all the accrual items and has been adjusted for any overstatement of value for some of the assets, such as in inventory and in debtors. Because if the stock's deteriorated, it's no use saying it's got a value that reflects brand new 100% quality product if it's devalued, and the business is not going to be able to recover that amount. And it's important that there's an updated predictive accounting report prepared, looking at budgets and cash flow forecasts. What are the changes? Because the real accounting role is to be able to be the storyteller, to be able to be saying to the leadership team, well, because of the changes in inventory, because of the problems in getting supplies from Europe or the Middle East, and because of the shipping delays that have been caused by the war, there's pressure on the cash flow because we're paying for stock but not getting it for weeks longer. And because of all this, the management team want to increase the level of stock that's being held in any case, because we run out of raw material, we've got nothing to process. But all this has a day of reckoning, and it basically comes back to being a day of reckoning within the cash flow forecast. So what changes are needed? And what alerts does that then give you? Does the business need more capital? And is that going to come through loan funds? If so, does the business have assets that can be offered as security? Although there are some of the bankers these days which will lend without security, but that might be at a level where the cash that's required can be raised. Or should the company be considering trying to raise capital as a crowdsource funding equity raising company? Is the international turnover less than $25 million? Could raise up to $5 million in a 12-month period if that's the case. But if the company has already grown beyond $25 million, the consideration will then be to look at going to business angels and to other investment groups, or even doing a listing on the stock exchange. So having this information and being able to use it to have some early conversations with your clients, to forewarn your clients that these problems are emerging, gives time for organizing things to happen. So the financial interpretation of results is very important. So we've analysed the projected balance sheet. So with these changes that have occurred, you should have balance sheets, I think, projected balance sheets 1 year, 2 years, 3 years in advance. The business valuation determination can then be made. Now it's made on the net profit before earnings, before interest, taxation, depreciation, and amortization. So what is that figure? And is there further adjustments required? Does the client's business use their own premises and they haven't charged a market rate of rent for those premises? That's an adjustment that's needed. Is there a commercial rate of payments being made to the CEO, who also may be the major shareholder and doesn't want to pay himself too much? But is there a commercial rate being paid? If not, an adjustment needs to be made. Or the alternative could be, of course, where there's been overpayment. There's wages being paid to various family members who are not gainfully employed in the business. An adjustment would be made the other way for that, so that we ended up with an adjusted expected profitability. Now, part of this analysis should always look at growth trends. What's all this information tell us? The age of the business comes into play in looking at what a business might be worth. What information technology does the business have? Does this stand them out as being a market leader, or are they well behind trying to play catch up? Because in calculating a value of the business, to calculate the return on investment, we need to be realistic. If the business has rundown assets that need replacing, we need to take that into account, because otherwise we're going to be calculating an incorrect return on investment. And some other key consideration can be patents. So they running out of time. The 20 years is getting close to being finished. We've only got 2 years to run. What's that going to mean in the marketplace? Is that going to mean that our key product, which has been generating substantial revenue, will then run into all sorts of competitors who can access the patent details? That's public knowledge, and launch competitive products from 2 years and 1 day's time? The similar situation relate to brands? Is the business up to date with its brands, or have other people got products? Trademarks, customer lists, suppliers agreements. All these types of things are part of the items normally considered under goodwill of a business. But when we're starting to think about how we might value this business on an ongoing basis so that an appropriate or closer to a correct calculation on return on investment can be prepared. What's the management team's experience? Are we employing this level of people that are required? If the CEO wasn't running the business, would the management team have to be improved? Would there have to be one or maybe even two new significant recruits brought in to bring in a similar amount of expertise? And what's the cost going to be for that? And how's that going to be reflected in the forecast profitability, which will obviously be the key part of the return on investment calculation? What's the capital expenditure program that's been undertaken? And whilst it's called capital expenditure, is this major repairs and maintenance, which again can affect the valuation of the assets being run down? Are they being reflected at values that are not realistic? So what's the business valuation in 1, 2, or 3 years' time? So now we turn to how do we turn all this data into action matters? Businesses need realistic financial results prepared on an accruals basis. I did indicate that earlier, but far too many SMEs are doing all their planning and thinking on a cash basis, and that can be ignoring substantial liabilities that haven't been brought to account. So they can be receiving information based on those cash accounts which are not correct. Businesses need weekly performance and profitability reports to ensure that any problems are identified promptly and fixed. And I've said that before too, and I'm just repeating in summary what's very necessary for a business. And business valuations should be prepared at least annually so that a realistic return on investment can be calculated. And by bringing all of the costs and all of the realistic asset values and proper liabilities into account, you're giving your client the best possible understanding of what's really happening within their business. And key performance indicators and business metrics are very important to this process. And I think they should be being looked at on a weekly and monthly basis, because if there's a variation, it will stand out like the proverbial. It's very clear. Gee, we've been running along 36, 37, 39, 38% gross profit percentage, and suddenly it's coming in at 22. What caused that? What's the problem? What's gone wrong? And that's why this information and these types of records are vital within your client businesses, because they convey the information. The information's within the figures. The figures just need to be prepared in such a way and then analysed that it's very clear. Gee, we have a problem there. My proposal to you, this information needs to be acted on weekly, not in a year's or 18 months' time when the financial accounts for the previous financial year are available. It's a bit late to go back and take corrective action then. And it could have been fraud, or it could have just been a mathematical errors that have continued right through because someone put together the wrong formula for a certain calculation. So businesses need proactive accountants to implement everything that I've been discussing with you today. It won't happen unless accountants are involved. I've talked to many SMEs and they've got that many other things on their plate. They're worrying about the market, the product development, the sales, the communications, team training. To be sitting down and analysing figures the way we are discussing today is not possible in the time allocations that they have. This is where you come in and supplying them this service, but you need to be able to communicate this to your clients, that you are able to undertake real accounting services. Because if you were working in a public company, this is the sort of work that accountants undertake. So the implementation of this monitoring process is beyond the capacity of the vast majority of SMEs, unless they employ an accountant to implement the strategies. The vast majorities of SMEs will not want to employ a full-time accountant or chief financial officer because of the cost, unless their revenue and overall performance justifies it. But we're looking at companies and businesses that are very small and are growing. And sure, some of them will probably outgrow the services that you're able to provide because they'll need a full-time person. But perhaps the partner in charge will then be involved in being a director of the company, if you wish, or an ongoing advisor on a board of advice, and obviously being paid a fee. With today's software technology communications, accountancy firms that have undertaken the required preparation and are linked to an experienced advisory service provider can introduce a range of financial, commercial, management, accounting, advisory services to assist SMEs to survive and thrive the challenges that are out there in the marketplace. But they need your input. There's a lot of problems with SMEs at present. Read some of the small business ombudsman's reports that we have uploaded on our website. There's a lot of problems. ESS BizTools has developed these services. The financial, commercial, management, accounting, advisory services, which we believe those three categories are the vital ones to help your clients succeed. So we've developed the services to help you, accountants, bookkeepers, business advisors, to deliver these types of services to your clients. And we'll help you every step of the way. We've got detailed forms, 40 separate product packages, from research and development, from chief financial officer services, from the 52-week business enhancement system, right through checklists, summaries, articles you can send to your clients about how the 52-week business enhancement system operates, short videos to help your team understand the process so you can deliver an outstanding service. So you want to know more? I hope you do. Please visit www.essbiztools.com.au and click on the product packages that have been developed to assist you, professional advisors, to deliver these key financial, commercial, management, accounting, advisory services that your SME clients really need. These services assist also in talent attraction and retention for professional firms. And every time I talk to a principal of an accounting firm, over the last 2 years, I've heard complaints about talent attraction and retention. The younger generation are not prepared to sit there and work all day on tax returns. They want some variety. This type of work will give them variety. And then when they're doing the tax return, they know the full journey then. They've been there. They've implemented part of the daily reports, then the weekly performance reports, and they know how they're being used by the leadership team, the monthly financial accounts. They've understood the business planning and budgetary processes, cash flow forecasts, projected balance sheets. They've understood why we're looking at the valuation of the business or the company and looking at the forward projections. What's the cash position likely to be? This is what happens in bigger businesses. There's no reason with today's software, technology, AI, and the communications like we got now that prevents accountants from delivering this type of service. Sure, you may have to do the sole job for a while and start building up to it. But we've got subscribers that are charging between $40,000 and $140,000 per annum for the delivery of these types of services. I think the guidance is really keep the costs below what it would, the realistic cost of the employment of a full-time accountant or a chief financial officer. So if you'd like a complimentary 40-minute Zoom meeting with me to review the opportunities for your professional firm, please send me an email, peter@essbiztools.com.au, and we'll get back to you. Or you can give me a phone call if you like, 0418 190 181. Because we're here to assist you with the practical experience that I've developed from my accounting career, real life accounting career. Senior partner of an accounting firm, chief financial officer and company secretary of a listed public company, an advisor on a major Australian government program, COMET, Commercialising Emerging Technology. There were only 12 of us in Australia handling that program, which was sponsored in effect by John Howard as Prime Minister. He wanted a better package out there to help evolving businesses. So we had to get them shipshape, get their business plans, their budgets, their vision properly documented, and then assist them to be able to make investment presentations to raise capital. And this was all under Section 708 of the Corporations Act, which is nowhere near as flexible as what is now available under the crowdsourced funding, equity raising legislation, or early stage innovation company capital raising processes. So I look forward to hearing from you so that we can work with you on this journey of supplying outstanding financial, commercial, management accounting services to your SME clients. Have a great day. Goodbye. Thank you very much. And I look forward to hearing from you.